Good morning, ladies and gentlemen. My name is Salih Ibrahim from FCA, and today I want us to discuss risk management in strategic financial management. We were not able to cover this sufficiently in our physical class, and I promised that I was going to do a video tutorial that will enable you have a supplementary material to use for this. So let's get started without wasting time. I will not waste time because we have a lot to cover here. So the course is strategic financial management. So our risk management is divided into two: the foreign currency risk management and interest rate risk management. So I will discuss the two, but I will start with foreign currency risk management. Foreign currency risk management. Foreign currency risk management. Okay, so foreign currency risk exists when you have an entity dealing with other entity outside its country of domicile. If you have a Nigerian company, you also be individual anyway, you have an entity dealing with a supplier or a customer in the United States, a customer in Great Britain, a customer in Japan. Once that transaction is outside the local country of the company or the entity, we say there is a currency risk. The currency risk there is that between the time that the transaction is consummated and when the settlement is actually done, exchange rate can move from to any direction. Exchange rate may move from favorable to unfavorable, for instance. So there may be a unfavorable movement of exchange rate against the company, and that is what the company wants to protect. We want to protect ourselves such that our exchange rate does not move adversely against us, and that's the risk management. What is the danger of exchange rate moving against you? The danger of exchange rate moving against you is that you have unpredictable cash flow position. Your cash flow projection fluctuates. You are not, it's not reliable. Okay, it's not reliable. You don't have a reliable position. You don't have a reliable position, and that's what the company want to protect. We don't want our cash flow to fluctuate. We want to have at least reasonable certainty regarding our cash flow projection. Okay. So let us discuss some concepts. Let's discuss some concepts on this topic. Sorry. Let's discuss some concepts. One, let's talk about exchange rate. What do you mean by exchange rate? I don't want to waste time. Exchange rate simply means the amount, or we call it units, of one currency, that can be exchanged for a unit of another currency. So e.g. 1,500 naira to $1. That's what we call exchange rate. Okay. All right. 2, exchange rate quotation. Exchange rate quotation. Now, exchange rate can be quoted in 2 ways. We have the direct quotation, direct quotation. And when we say direct quotation, what do we mean? This represents the units of domestic currency, the unit of domestic currency that can be exchanged for a unit of foreign currency, for a unit of foreign currency. E.g., like I gave earlier, 1,500 to $1. Our local currency, for example, if our company is in Nigeria, is the naira. So we have seen that 1,500 is needed to get $1. So when you have exchange rate in this one, we say the quotation is what? It's a direct quotation. Direct quotation because naira comes before dollar, and dollar is right hand side. Naira is what? Is the left hand side. Now, this one here is called the base currency, or the base currency. Then this one here is called the price or quote currency. This is the price currency, price or quote currency. This is the fixed or what? Or base currency. The base currency is the currency you can buy or sell. You buy and sell dollar, buy and sell dollar. What is the price? The price is in naira. Okay, the price is in naira. So indirect quotation. Indirect quotation. Now, this is the opposite of direct. This is, or this represents the unit of the foreign currency, of the foreign currency that can be exchanged for a unit of the domestic currency, e.g. 0.004 to 1 naira. That's what? That would be an indirect quotation. Once your foreign currency is coming before your local currency, we say the quotation is what? Is an indirect quotation. Now, number 3, let's talk about bid and offer prices. Bid and offer prices. The bid price, that is the rate at which the dealer here may be bank, e.g. each bank is willing to sell, sorry, is willing to buy the currency. Okay, why the offer price, that is the rate at which the dealer is willing to sell the currency. That is bid and offer price. Then we have what we call the bid offer spread. The bid offer spread. The bid offer spread. This is the difference between the offer price, and the bid price. This represents the profits. So it represents the profit of the dealer. Okay, so now normally the dealer is expected to buy at a lower price and sell at a higher price. Buy low, sell high. Buy low, sell high. So the bank is making a gain, and that is the difference between the offer price and the bid price. The price at which is selling and minus the price at which is buying. That's the bid offer price, and that is the profit to the dealer. Okay. Now let's talk about spot rate. Spot rate, this is the rate. This is the rate at which a transaction can be settled as of today. So I enter into a transaction and it's a spot transaction. The price at which that transaction can be settled today is the spot rate. Then we now have the forward rate. Forward rate. This is the rate sorry, 1 minute. Plug my charger. Okay, so forward rate, we said this is what? This is the rate this is the rate agreed today for a future, sorry, let me say for a transaction, for a transaction that will be settled, in the future, for a transaction that will be settled in the future. That is a forward rate. So we agreed the rate today, but the transaction is not happening today. The transaction is happening in a future date. For instance, I can go to a bank and say, I have $5,000 obligation to make in 3 months' time. I want us to agree the rate at which you'll be selling dollar to me in 3 months' time. And the bank says, okay, I'll sell to you at 1,450 naira. So we have agreed the price today, but that transaction will not happen today until 3 months' time. That's what we call forward rate. So forward rate can be predicted using market dynamics. Okay, we have several ways of predicting the forward rate. Now, this forward rate, we can calculate what we call, okay, before that, let me first discuss forward premium, or what? Or discount. Forward premium or discount. The forward premium or discount is the difference between the forward rate and the spot rate. The difference between the forward rate and the spot rate. That is what? That is the discount or premium. If the difference between the forward rate and the spot rate is positive, we say it's a premium. If it is negative, we say it's what? Is a discount. So if positive, we talk of what? Premium. If negative, we talk of what? We talk of a discount. So if this is positive, we say the spot rate is quoted at a premium. If it is negative, we say the spot rate is quoted at a discount. Now, that's not what we call, that's number 6, annualized percentage premium, annualized percentage premium or discount. Annualized percentage premium or what? Or discount. Annualized percentage premium or discount. So we want to see annualized. You know, exchange rate is quoted for different periods. We can have exchange rate quoted for 1 month, exchange rate quoted for 1 month. In fact, you can even have exchange rate quoted for 1 day, 1 week, and 2 weeks, 3 months, 4 months, 6 months, 9 months, okay, and so on and so forth. Now, when you want to calculate percentage premium. We want to know whether the currency is quoted at a premium or at a discount. We need to calculate the annualized, meaning that you convert it from whatever quotation is, whether it is 3 months, we are converting it to 3 months to what? To 12-month premium or discount. Okay, so what's the formula for this? Annualized premium or discount annualized premium or discount. What is the formula? Is given as forward rate, which is FR, minus spot rate over spot rate multiplied by 12. 12 because we have 12 months in a year. So 12 over number of periods quoted multiplied by 100 over 1. Multiplied by 100 over 1. Okay, 1 minute. Okay, multiply by, or if you so line, you can say let me put it here so that it will be easier for you to remember. Let me put it as number of months forward. So that I know that I could calculate it forward. Okay. Let's say number of months forward multiplied by 100 over 1. So that's the formula for calculating annual premium or annual discount. Now, let's see. Let's take some example on this. Examples. 1, let us assume that our spot rate, let me write it in full. Let's assume that spot rate, is 1,500 to $1, and 3-month forward rates. 3-month forward rates. Three-month forward rate, let's assume is 1,600 to $1 to $1. Now, I want to calculate annualized forward premium, PM, or what? Or discount. Annualized forward premium or discount. So let's see. Forward premium or discount. Forward premium or discount is equal to, let's use the formula, spot rate. Forward rate? Our forward rate is 1,600. What's the spot rate? 1,500 over the spot rate. Which is 1,500 times number of months, 12 in a year. Then 3 months is the quotation. Then convert this to percentage, 100 over 1. Okay, so we have 100 over 1,500 times 12 over 3 multiplied by 100 over 1. So what do we have? Let's get that done. 100. Let me have my calculator. Okay. So we have 100 divided by 1,500 multiplied by 12 divided by 3 times 100. We talk of 26.67%. So we have 26.67%. That is, now, this is positive, Abby. It is positive, so the spot rate is quoted at a premium. Okay, don't forget, we say if it is positive, it's premium. If it's a discount, if it's a negative result, it's a discount. Now let's look at situation of a discount. Now, I want to show you something. Let me do this. Do I open another this thing? Okay, let me just let me save this one and okay, let me just share instead. Let me share it. So that will save time. Let me just share it. Okay. Let me confirm that it's actually shared. Okay, fine. 28, I think it's shared. Okay, I have it now. I have it. Okay, so let's go back. Let's go back now. Let me open a new tab for this. Okay, let me save this one as well. I want me to save it. Let me be on the safer side. Let me also save it on my file, on my folder. It's my folder, folder. Okay, so I have SFN, FC, and IR, MGT management. Okay, so this is FC note 1. FC note 1. Good. All right, so let's take the second one. I hope we are still up and running. Okay, good. No, we are still up and running. Now, let's take the second one here. We have seen that of a premium. Let's look at situation of a discount. That will be 2, Abby. That will be 2. And let's say we have our spot rate. Let me write it 4 as usual. So we have the spot rate. And the spot rate is given as 1,600 to $1. But our forward rate, 3-month forward rate, forward rate. 3-month forward rate is given as let's say 1,500 to $1. So calculate annualized percentage premium or discount. So forward premium or discounts would be equal to, the forward rate is 1,500, spot rate is 1,600. So over 1,600 times 12, number of months forward is 3, multiplied by 100 over 1. So if you solve this, we're going to have minus 100 here, minus 100 over 1,600 times 12 over 3 multiplied by 100 over 1. So 100 divided by 1,600 multiplied by 12 divided by 3 times 100. 25%. Let me confirm that figure. 100 divided by 1,600 multiplied by 12 divided by 3 times 100. 25%. 25%. So you can see that the rate of appreciation is different from the rate of depreciation, even though we use similar figure. In appreciation, premium and discount. In premium, spot rate 1.15, forward rate 16, and our premium is 26.67. But look at this, I just reverse it. Spot rate 16, forward rate 15, and it came out to what? 25% discount. What that means is that forward discount, forward period might not be the same figure, even though you reverse the quotation, okay? Even though you reverse the exchange rate, it might not still be the same. All right, that's a forward rate, forward premium and discount. Now let's move on to cross rate. Cross rate. Cross rate. Cross rate. Okay. Now, cross rate is the way of determining the exchange rate between two currency pair in the market that is not apparently given in the market. What do I mean by this? In the FX market, not all currency pair are quoted. You don't have pair for all currency. For instance, we don't have pair for dollar to naira. We don't have pair for GBP to naira, and so on and so forth. But if I know two currency pair in the market, okay, based on the two currency pair, I may be able to calculate the third currency pair using the concept of what? Of a cross rate. Let's go to the material to see whether I have example of that. Cross rate. Okay. So look at it. We said this is the implied exchange rate between currency A and B based upon the explicit rate between currency A and C and currency B and C. It is the exchange rate between two currencies derived from their exchange with a third currency. Now, let's take an example here to see this currency, this cross rate. Let's say we have a GBP to dollar to USD, GBP to USD to be 0.8543, and I have EUR to USD to be 0.7563. Now, I want to calculate the exchange rate, calculate GBP to euro, GBP to euro exchange rate. Calculate GBP to euro exchange rate. Now, what I need to do here, look at it. I have this currency pair. It has GBP and USD. I have another one. It has euro and USD. But I don't have the one with GBP to euro. And that's what I want to calculate. Based on these two given rates, I can calculate the GBP euro exchange rate. So what do I need to do? Let's quickly do that. I want to calculate EUR, that is euro. I want to calculate the euro GBP to euro. I want to calculate GBP to EUR exchange rates. Now, I have GBP, I have GBP to what? To USD. You can see that I have GBP here, I have GBP here. So that's fine. I will now say times the second quotation, which is what? Which is EUR to what? To USD. Now there is a problem. What is the problem? I have GBP. Normally, my GBP should be up and euro should be what? Should be down. But look at this one here. I still have, there's no way I can arrange this. There's no way I can arrange this the way it is for me to have GBP to euro, because what I want to do here is that I must arrange this exchange such that the dollar is cancelled out. Okay, I have to arrange the two quoted rates such that the dollar is eliminated, leaving me with GBP and euro. But with what I have there, that is not possible for now. The way it is said, you cannot cancel it. So what do I need to do? If you see that you cannot cancel like this, you just have to take the inverse of this. You need to invert it. You need to invert this exchange rate here. Raised to power -1, meaning that you want to change the arrangement. Now, you are not going to invert GBP because GBP is what I need as the numerator, and it's already here as the numerator. But I don't need euro as the numerator. I need to take it back to the denominator. That's why the pair I'm inverting is the euro USD rate. So doing this, I will have GBP to euro to be equal to GBP to USD. Now, when you invert this one, it becomes USD to what? To EUR. That is what the inversion will do for you. That is what the inversion will do. The inversion will change the arrangement of this currency. The one down will be up, the one up will be down. We are taking the inverse. So now I can cancel these two USD here. They can cancel each other, leaving me with what? Leaving me with GBP EUR. So let us apply that to solving this question. Now to solve this question now, I have my GBP EUR to be equal to, what's our GBP USD? GBP USD is 0.8543 over, that is 0.8543 multiplied by the second rate that we want to invert is what? Is 0.7560. You just say raised to power what? -1, because that's what we want to invert. So here we will have we have GBP, EUR to be equal to 0.8543 multiplied by 1 over 0.1. Let me check that. 0.7563. Yeah, 0.7563. 0.7563. So let's do that. 1 divided by 1 divided by 0.7563 equal to this, multiplied by 0.8543. So our exchange rate of GBP to EUR will be equal to 1.296. That is how to deal with cross rate. Let me give you one more example. This time around, look at it. Let me say example 2 for cross rate. Let's say we have this quotation. We have a JPY USD. JPY USD to be equal to can I still remember how this is quoted? It's a 4 decimal places. I can't actually, let me use another quotation. I can't remember how many decimal places you have for this, so that I will not give you a wrong quotation. So let's say we have which rate can I use? Let's say we have USD to GBP to be equal to 1.3340 to 1.3345. And we now have euro to USD, euro to USD to be, let's say 1.0 to USD 1.2164 to 1.2344. Now, calculate the bid and offer prices for Euro GBP, for Euro and Great Britain pounds. Calculate that. Now, what are we going to do here? Don't forget in our quotation, this is the bid. This is what? This is the offer. This is the bid, and the other one is the offer. The offer price should be more than the bid price, right? Yes, should be more than the bid price. Now, let's see this. If I want to calculate the euro USD, Euro GBP. Euro GBP. I want to calculate the Euro GBP bid. Okay. Now, let me take USD, GBP, USD GBP, multiply by Euro, Euro what? Euro USD. Now, here, I don't need to invert. Can you see that from this arrangement, the USD cancels out? So I can do this, I can just do this straight without any inversion. I don't need to invert anything. Directly, when I wrote the quotations out, I discovered that the USD can cancel USD. No inversion is needed for this particular solution. So what do I need to do now? I will now say, what is the bid? USD GBP is 1.3340, and then Euro USD bid is 1.2164. From this, we see that the bid price is what? 1.3340 multiplied by 1.2164. That's a we have 1.622, 1.622, let's say 7, approximately 1.6227. What about the bid? The euro, for the euro GBP offer, euro GBP offer. For the euro GBP offer, so the arrangement still remains the same. We have already gotten that from here. But this time around, instead of the bid, you are using what? The offer price. So I will simply have 1.3345 multiplied by 1.2244. So let us multiply. 1.3345 multiplied by 1.2244. We have a 1.633, okay, 1.634 approximately. 634. 1.634. 1.634. So we now say the euro GBP bid offer price is equal to 1.6227 to 1.6340. Okay, so that will be your solution to that cross rate problem. Okay, let me save this before we continue. Let me make it longer. I think it will be longer. It's too short, man. Okay. FC note 1, note 2. FC note 2. Foreign currency note 2. So we have two notes. All right, let's go back to our material. We have discussed cross rates. We have discussed cross rate. So let's quickly talk about theories of exchange rate. So I'm going to discuss purchasing power parity, interest rate parity. The international, okay, I will discuss it briefly. I won't go much deep into that. Now let's take them. Then we have the expectation theory anyway. All these one are just something you just need to know by theory. Okay, know what they mean. Now let's look at interest rate parity theory. Now the interest rate parity theory states that spot exchange rate, forward exchange rate, and interest rate are technically linked for all currencies that are part of the free international market. So, interest rate parity theory is simply saying that if I know the spot rate between two currencies, I know the respective interest rates on the two countries that have those currencies. I can predict the exchange rate for a future period. Okay? Normally, the theory is saying exchange rate between two countries is expected to be the same. The only factor that will make the exchange rate of two countries not to be the same is in their interest rate, the interest rate of the respective two countries. That is what can make the exchange rate not to be the same. Now let's go and see. Sorry, I don't like that. Check correct. Okay. So what I call it, theory of exchange rate, theory of exchange rate determination. Theory of exchange rate determination. So the first one, we say what? Interest rate. Interest rate parity theory. That is IRPT. Now, you don't have to struggle to understand this. Now, what this is saying is that spot rate at time t, that is rate of exchange at a particular period in the future, is the current exchange rate as of today, that is today's spot rate, multiplied by 1 plus IA, 1 plus IB. I prefer to use IA and IB. I don't like using interest rate of foreign country, interest rate of a domestic country. It looks confusing to me, and that is why I don't buy that idea. Now, what we have, let's do this. ST is exchange rate at time period, that's T, that's a T, at a particular period, maybe next month or whatever. Now, SO is the spot spot exchange rate, spot exchange rate as of today. Spot exchange rate as of today. Then IA is interest rate of country A. Then IB is interest rate of country B. Now, we want to use this formula. What I want you to do is that just look at the currency of the spot exchange rate. Okay? Just look at the currency of the spot exchange rate and identify which country spends that currency. If the currency of the spot rate is United States dollar, for instance, in the numerator, that is IA, the interest rate of inflation should be there. Okay? Interest rate of inflation will be there. So what that means is that the currency of the spot rate, the country that spent that currency, the inflation rate of that country is what is expected to be up, while the inflation of that country will be down. For instance, spot rates, if you have spot rates, and the spot rate is 1,005 a dollar, and the Nigerian interest rate is 10%, while US interest rate is, let's say, 15%. Based on this, I can predict exchange rate for next year. Okay? So compute exchange rate for next year. Exchange rate for next year. So in that case, I will have rate at period T. What's our current exchange rate? 1,500 is the spot rate, and it's in Naira. Which country spends Naira? Nigeria. So the Nigeria inflation will be up. So Nigeria interest will be up. It's 0.10 over US interest will be down. 1 plus 0.15. So ST will be 1,500 multiplied by 1.10 over 1.15. ST will be equal to 1.1 divided by 1.15. 1.1 by 1.15 multiplied by 1,500. That is 1,000. Exchange rate for next year should be 1,434.78. Okay, so that is the interest rate parity theory. That's the interest rate parity theory. So a variant of that theory is purchasing power parity theory. Okay, that's a variant of interest rate parity theory. The only difference between interest rate parity theory and purchasing power parity theory is the fact that purchasing power parity theory predicts exchange rate based on inflation. Okay, while interest rate parity theory predicts exchange rate based on interest rate. So the same application, the same formula is what you need to know. There's no significant difference between the two. Only the name of what they use to calculate exchange rate. So number 2, purchasing power parity theory. Purchasing power parity theory. That's a PPPT. PPPT. A minute. So the purchasing power parity theory, like I said, is used to predict exchange rate based on the fact that it is expected that a country with a higher inflation rate should have its currency depreciate over time, okay, against the other country with a lower inflation rate. So when you have a country, you are predicting exchange rate between two countries, and the inflation rate of one of the currency is higher than the other, then we expect that the currency with the higher inflation rate should be depreciating. Okay, that's the purchasing power parity theory. And the same formula, like I said earlier, the formula is I have my current exchange rate, current spot rate. Okay, so I want to predict ST, that is spot rate at a period in the future. And that is given as what? SO multiplied by 1 plus IA over 1 plus IB. Like I said earlier, I prefer to use IA and IB. I don't like the concept of inflation of foreign country, inflation of domestic consumption. Otherwise, if that is what I've crammed, the danger in that is that when they give you an indirect quotation, it becomes difficult for you to identify which one is the home currency, home country, which one is the foreign country. Don't forget, I've told you that when you're writing the exam, you don't have to look at where your physical body is for you to say, this is your local currency. For instance, if your country, you are writing the exam in Nigeria, and the country they give to you is domiciled in the United States, of course, it means your local currency is what? Is the United States dollar, not Naira, not where you are. It's where the company is that you are making reference to. Do you understand? So here now, the ST, like we have it before, exchange rate at time T, spot exchange rate is SO. IA now, the IA is the inflation rate of country A, inflation rate of country A, while IB is inflation rate of country B. Inflation rate of country B. Okay, so let's assume we have this. We have a spot rate. We have spot rate to be 1,500 naira to $1. To $1. And Nigeria inflation rate, let's assume is 10%, 10% per annum, and the US inflation rate is 15% for simplicity. So if I want to predict my exchange rates, I will have ST. What is our spot rate? Our spot rate is in Naira, right? 1,500 Naira. I want to predict exchange rate for next year. So the spot rate is in Naira. Therefore, the inflation rate that should be in the numerator should be the Nigerian inflation rate because it's Nigeria that spend Naira. You understand? So I will have 1 plus 0.1 over 1 plus the other currency, which is the United States dollar, 1.15. So our ST, which is spot rate at time T, will be 1,500 multiplied by 1.10 over 1.15. So ST is equal to 1.1 divided by 1.15 multiplied by 1,500. 1,434 1,434 Naira to United States dollar. Okay, 1,434.78 to $1. Okay, so that's our purchasing power parity theory. Now, expectation theory. The expectation theory is based on the fact that the forward exchange between two currencies reflect market expectation, okay, market consensus, market agreements, okay. When we say market, we are talking of the forex market, the dealers in the market, what we expect, what they expect exchange rate to be in the future. Okay, that's what we call market consensus. And that's what it is referred to as what? Expectation theory. You don't actually have a calculation for that. It's just for you to know what it means. Okay, we are not going to apply it in the exam, but you might be asked to just explain your understanding of expectation theory. So expectation theory is the theory that all relevant information is reflected in the market rate of exchange. Okay, market exchange rate. All information about the currency, about the two currencies, all the information regarding the two currencies is already reflected in the exchange rate. So market participants have expectation of what the exchange rate is expected to be in the future. Okay, that is the expectation theory. That's expectation theory. Okay. All right. Now let's go to the currency risk management proper. How do we manage currency risk? How do we manage currency risk? How do we protect ourselves against adverse movement in exchange rate? Don't forget, I told you, the objective of a company is not to make a gain from hedging. It's for you to protect yourself against adverse movement in exchange rate. And why? You want to have a predictable cash flow projection. If your foreign obligation or your foreign receipt fluctuates in line with your exchange rate, you see that it will be very difficult for the company to project with reasonable certainty cash flow for a period of time. So you have fluctuating cash flow position, unstable cash flow position. And that's the reason why the company wants to protect itself against adverse movement in the exchange rate, okay? So that whatever happens in the market, at least you are reasonably protected. Now, that's I will call it hedging techniques. Hedging techniques. Hedging techniques against adverse movement. Adverse movement. Adverse movement in exchange rate. adverse movement in exchange rate. So we have two broad techniques. We have the internal hedging techniques, Under the internal hedging techniques, we have the leading and lagging, We have invoicing in home currency, invoicing in home currency, that is in your domestic currency. We have matching. We have matching. We have a netting. Then, of course, we have do nothing. Do nothing is also a technique for hedging. Do nothing. You just leave your faith in the hand of God. You are doing nothing about the exchange rate, okay, movement. Okay, that is do nothing. Now, when we say leading and lagging, what do we mean? Leading and lagging means you accelerate the payment. Your supplier has given you 3-month credit, say, for instance, pay within 3 months. But you have, from your prediction, from your study of the exchange rate movement, you discover that exchange rate may likely move against you before the 3-month credit period lapses. In that case, what do? You quickly accelerate the payments. That's leading. You accelerate the payment in anticipation of what? Unfavorable movement in exchange rate. That is leading. While lagging means you delay the payment when you expect that exchange rate will move in your favor. That is what? That is lagging. So leading and lagging. So for you to use leading and lagging, okay, you must have in-house experts who can actually predict the movement in exchange rate with a good degree of accuracy, okay? Because a wrong prediction can pose a detrimental effect to the company, okay? So for you to use it very well, you must be able to predict the movement in exchange rate with at least reasonable degree. Okay, then we have what? We have invoicing in home currency. Invoicing in home currency simply means you insist that your foreign transactions, whether foreign receipts or foreign payments, is denominated in your what? In your currency. For instance, let's say you have a supplier in the United States who has sold a product to you. Okay, he has sold a product to you, and you want to protect yourself against adverse movement in exchange rate. What you can do in that case is for you to insist that the invoice prepared by the supplier must be denominated in naira. In that case, when you are making the payment, you are making the payment in naira, so you are not exposed to exchange rate fluctuation. Okay. However, the practical problem with that strategy is that before you can command that kind of arrangement, you must be a major customer of that supplier. If your purchase represents just like 3% of the total revenue per annum of the supplier, you cannot actually force the supplier to prepare your invoice in your domestic currency. Okay, so before you can use it satisfactorily, your transaction must account for a good percentage of the our suppliers' total revenue. Okay, so that the supplier does not want to lose you to a competitor. Let's say your purchase is like 30% of the supplier's annual revenue. So no supplier wants to lose a customer that is accounting for 30% of his revenue per annum. Okay. Then what about if you have a customer you are selling to over there? You are selling to a customer over there. You are saying, my customer, this invoice I want to prepare, I'm going to prepare it in Naira. I'm not preparing it in dollar. So you are giving the invoice to your customer in what? In Naira. So when he is paying you, he's actually paying you your domestic currency. So by so doing, you are not exposed to exchange rate. Now, we have netting. Okay, netting. Netting will work if you have a foreign receipt and a foreign payment in the same country and of almost the same amount. Almost the same amount. I have someone who is owing me $10,000 in the United States, and I'm owing someone approximately $10,000 in the United States. So, and they're having the same maturity. That is also very important. Maybe in 3 months' time, in 6 months' time, whatever. So, if I'm having that arrangement in that country, then I can say that if I collect my receipt, I can use it to settle my liability. Okay, that is netting. You net it off. You net your payment against your what? Against your receipt. So for you to use that, one, the two currency must be in the same what? In the same country. Two, they must be of almost the same amount. And three, they must have the same maturity. Okay, for you to use netting. Then we have matching. Now, matching, you can match receipts against payments. And this is used mostly by multinational companies. Multinational companies with subsidiaries across the globe. A Nigerian parent having subsidiary in the United States, in Japan, in China, in Ghana, okay, across the globe. Excuse me. We have subsidiary across the globe. And you know, this subsidiary, they conduct transactions within the group. Okay? They conduct transactions within the group. So, what you want to do, you don't want the subsidiaries to be settling those transactions among themselves. So, the company can organize to settle that transaction centrally from the head office. So what do they do? What does the company do? The company will translate all the transaction among those subsidiaries to the local currency of the parent company. And from there, they do what? They do what we call matching until the number of transactions needed is what? Is reduced to maybe 1 or 2. That is what? That is netting. We can have bilateral matching or multilateral matching. Bilateral means just between two currencies, while multilateral means between more than 2 currencies. Okay. All right. Do nothing. I told you. Do nothing simply means you are actually folding your hands and looking at what happens to your to your transaction. Okay. So we stop this video here, and I will provide another video that will deal with external hedging technique. Okay, that will deal with external hedging techniques. Thank you so much. We meet in the next series of this video very shortly.